More now from Europe, where the ECB says it's raising its benchmark interest rate 0.25 percentage point to 1.25%. This as Portugal lines up to get a bailout. For more on Europe's ongoing struggle with the periphery and the core and inflation, we're welcoming Danny Blanchflower, a former member of the Bank of England's Monetary Policy Committee and a current Bloomberg contributor, joining us from Dartmouth this morning. So, Mervyn King.
Hi, Margaret.
Hey, Mervyn King and Ben Bernanke on the same page. Did Trichet make things a little bit more difficult for them today?
Well, King and Bernanke are on the same page. Bank of England didn't do anything today, thank goodness. And now we see Trichet doing, I mean, they signaled a month ago that they were going to do it. Everybody thought they would, and they did. They're certainly not on the same page as Bernanke and King, and it looks to me like a really big error. Look back, in 2008, July, the ECB raised rates even though they'd just gone into recession and had to reverse them very quickly. And this looks quite a lot like that. Looks like a pretty big mistake in my judgment.
Is this a consequence of being, too open in terms of communication? I mean, Trichet basically told us he was going to do this a month ago. I mean, did he box himself into a corner here?
Well, I think he did lock himself in. I mean, the markets had fully expected it, fully priced it in. But I read into the announcement from Portugal yesterday. Other people don't seem to have. But Socrates announced it the night before the vote,
right,
the council meeting. So I think that was quite strategic and probably quite clever. But the night before, he says, we're going to have to take bailout money, even though we don't really have a real government. We're an interim government, and the ECB goes ahead anyway. And Trichet in the press conference says, basically, the periphery are on their own, even though there actually isn't that much inflation and no evidence at all of wage inflation. So this does look very sort of doctrinaire, and he's sort of wiping his hands of the periphery. And obviously the worry is, what are European banks going to think of this?
Yeah, well, I mean, can he wipe his hands of the periphery? The last thing Portugal needed was a rate hike. It's going to make it even harder for them to resolve their issues.
Well, absolutely. It's going to make it harder for Portugal, harder for Ireland and Greece. And then we hear the Spanish government today saying, oh, we're just fine. But really, it's the probability of them being in trouble has risen. Think about 80% of the Spanish mortgages are flexible rates. And if more rate rises are coming, and you start with 20% unemployment, and just think the whole of the euro area starts from 10% unemployment, so I suspect you'll see everyone moving towards Spain and Italy. Doesn't look good. I mean, we've talked on this program. Should have sorted out Greece. Should have sorted out Ireland. Didn't. Now you've got Portugal. And who thinks it's going to stop here? You and I are going to be talking about this for some time to come.
Yeah. How are you doing on cash right now? Because let's look at this. Greece got $155 billion from the EU and the IMF. November. Right. Ireland comes out. They get $120 billion. And now Portugal, I mean, they're saying something's coming. It could be $107 billion. How much more can be done at this point?
I mean, how much more can be done? Obviously, the problem with Spain we've talked about. And the worry with Spain is that they potentially are too big to bail. But still, we should have in our minds, these are over-indebted countries who we're saying we're bailing them out by giving them expensive debt that they can't afford and assuming we've fixed it. Well, clearly, every single time we do it, we haven't fixed it, and it's going to keep going.
Well, so, and now, the banks have been told. I mean, this has been, what, a year now we've been talking about this? The banks have to have capital levels where they could withstand restructuring at this point. No? I mean, what is Europe trying to buy time for?
Well, I mean, the question is, how much restructuring are they going to have to do, and how far does this keep going? I mean, think about Spain. House prices have fallen. What if they start to fall further? Then what do the Cajas and Santander and everybody else do? So, and then we've got this stress test to come. So these have been, yes, you've got enough money and enough cash to sustain this shock, but what if the shock's worse? And that's the worry. I think it was interesting to hear Trichet say he thought the risks to inflation were to the upside. Yeah. I think you and I might think that's not probably the case.